boom in oil and gas is underway. It's like the rest of the resources boom, but no one's making any money. Stock prices are just bloody terrible, and it's, as I was saying, it's causing sort of great consternation, because you think, well, what are we really doing wrong? Alan made some lovely comments earlier on about the Australian mining industry and the entrepreneurial spirit, and at these sorts of presentations I like to really reinforce that point, that the Australian small cap resource sector is a wonderfully entrepreneurial asset class, and it's not quite unique, but it's nearly unique in the world. And we know that when it's on song, it can make a lot of money for investors. The ingenuity, the courage, the spirit of people in the industry is just outstanding. Unless you're in the mining industry or the resources industry, you probably can't see it in anywhere else. It's not like on the sporting field or in entertainment or so on. Certainly people can put their heart and soul into things, but when you're in the mining industry, you're usually building something, or the resource sector, you're building something, and a lot of things have been built, a lot of value's been added, a lot of spectacular things have been done, but at the moment people aren't being rewarded for it. It's a global thing, but it's an Australian thing. Now, our boom really is underway. We saw the GDP numbers that came out the other day, which were probably well above all our expectations. When we look around the streets, and it doesn't matter whether we're in Sydney or Brisbane or Perth or Melbourne, you see the shops that are closed, you see people feeling fairly miserable, you can see the asset values are down, and there's a general malaise about everyone. But at the same time, we've got really good prices for our products. Our companies are doing pretty well, but it's just not being shown up that this boom is well and truly underway. Some of the things that I spoke about last time were the introduction of exploration for unconventional oil and gas. Now, you're all familiar with coal seam methane, and that's been a great success story, or it should be a great success story. And we're going to see a lot of things happening in the shale oil and the shale gas. I mentioned that last time, and I think that there is a momentum growing there. I think we had Central Petroleum presenting last time. I underwrote the IPO for Central Petroleum and helped bring together the Amadeus Basin assets and to match it with the Bidurka Basin. And it was a bit sad to see that poor old John Hughes been rolled, but Richard Cotty has come in, and I'm hoping that Richard Cotty there will bring attention to the real value that exists in the Amadeus Basin and with Central Petroleum, and I think that might give a lot more profile to that unconventional activity in Australia and help promote this boom. So let's move on. What I wanted to do this time was to talk about some of the driving forces behind the energy boom in Australia. It's a response to demand in other parts of the world, and Australia is absolutely wonderfully well placed. So if we step back and talk about the investment outlook in terms of where we are in the global scene. Now, everyone's familiar with peak oil, aren't they? Everyone knows about that, and I think it's probably fair to say that conventional oil peaked in around about 2006. It's sort of taken a little while for everything to catch up from that, but we're still producing more and more liquids in terms of our 90 million barrels per day of liquid fuels that come out. Now, conventional oil has sort of peaked, but what we've seen is the growth have come from natural gas liquids associated with the LNG projects and a bit from the unconventional oil in the United States. So I think you've probably seen the numbers in the United States that we've got about 250,000 barrels a day from unconventional oil, which is not very much in terms of the US's 10 million barrels a day consumption. But that might get up to about 1 million barrels a day, but it's pretty small beer against conventional. So I think we're going to see oil prices in the longer term continue to rise over these supply side issues. And when we talk about the demand side, I'll show you in more detail, but it's really important for everyone to understand that non-OECD energy demand is bigger than OECD energy demand. It's a really, really important point. And the other aspect there is that non-OECD energy consumption has been growing quite quickly, whereas you'll see that OECD energy consumption has been fairly flat. So what's actually going to happen now that non-OECD energy is greater than OECD is that the overall energy demand will be accelerating in years to come. That's a strange thing to think about, but it will be accelerating. So we're going to have to find new energy sources. This global shale gas, and it's a global thing, it's not just the United States, it really is a major game changer, but it's not cheap gas. We need to keep that in mind. It is not cheap gas, and it won't be replacing the conventional gas that we have from the Northwest Shelf and various other places. As part of that shale gas action is the global LNG market. Now that I think is really very, very important for everyone to understand the role that's going to be playing. That will be very, very important to Australia. At the moment we produce about 23 million tonnes of LNG. There are a number of projects that are earmarked for development over the next decade that could maybe take that well over 100 to maybe 120 million tonnes of LNG a year, and that will make, as Mark was saying at our table, that it will make Australia the Saudi Arabia of energy, and I know that Cliff has been talking about that as well. You can see these numbers happening, and LNG is an important part of that. Australian, that should be energy stocks, are showing strong earnings growth. It's really interesting that in the first quarter of 2012, we had an outstanding performance by the oil and gas sector, and we had a whole bunch of all-time highs being achieved by companies like Drill Search and Cenex and Oil Search. Some really good performances. It's interesting to just think at the moment that on the last numbers I saw, resource stocks make up 119 of the ASX 300. This is an extraordinary number, and 19 of those were oil and gas stocks. 35 of them were gold, but the resource sector shares are becoming a bigger and bigger part of the overall market. And when we look at the Beach Petroleums and the Cenexes and the Drill Searches, Oil Searches, these companies have got outstanding fundamentals, earnings coming through, and without even talking about Burleson Energy, which clearly is just ridiculously priced at the moment. So there are good growth profiles right across the market. But the other side of that, of course, is globally the energy sector. Equities are extremely cheap. And I know that there are lots of stocks in the United States that are trading on PEs of 3s, 4s and 5s. So it's not just something which is happening in Australia. Yeah, so you can see that OECD growth in energy in million tonnes of oil equivalent has really done nothing for a decade, but look at this extraordinary growth in non-OECD. This is what I mean, that energy consumption is going to be accelerating in global terms. It has over the last year or two. It's going to continue to grow quite quickly. Now, this means that the great pressure is going to be put on all sorts of energy. breaking it down into the various sectors, this is OECD here, and here we're talking about million tonnes of oil equivalent. The total global consumption is about 12 billion tonnes of oil equivalent per year annual consumption. Coal for OECD is relatively important. Oil is much more so. Gas, nuclear, hydro, and renewables. Those who are pinning their hopes on renewable energy to provide all our answers, I think, are going to be very, very bitterly disappointed over the next few years. And when we look at non-OECD, look at the amount of coal, oil, gas. Nuclear is still very, very low in the non-OECD countries, and I expect that this will increase quite significantly over the next decade, and we'll see that when we start looking at China. And again, renewables up there is just an oil slick. It's not much, is it? Okay, now coming back to these oil consumption, we had a really interesting year in 2010 when we found that Chinese energy consumption exceeded that of the United States. Again, this is a really important thing for people to understand. Now, when we look at other commodities, and just look at steel, for example, world production of crude steel is about 1,400 million tonnes. China is about 720 of that. The United States is 90. Everyone needs to understand how significant China is in terms of demand for these raw materials, and why Australia's position is so very, very well placed for the next 20 to 30 years in this Pacific century. You can see that oh, I'm sorry, I've lost half my legend, but this one, no wonder you didn't know what it was. Europe's just shown no growth really for 20 years, or very, very low growth for 20 years, and that reflects all sorts of issues about making better use of energy in Europe. I think they've done a very good job about that, although it's very expensive. And this one is India. My apologies, I haven't got the right thing, but you can see India's growing, but compared to China, it's just, well, it's an also-ran. But just look at this extraordinary growth. I actually had a look at some of the GDP numbers for China over the weekend, and the GDP in China is about $5.5 trillion US, and if you go back about 5 or 6 years, you'll see it's about 2,000. So sorry, it's more than that. You go back about 10 years, but it's fascinating to put the GDP of China up against the Shanghai stock market. And the Shanghai stock market is at the same level it was in 2000, and but GDP has gone up an enormous amount since then. But this is such a staggering chart to show just how significant this growth is, and it's not. I just don't believe it's going to fall over. I think it's going to continue to grow. Now, when we start looking at the different makeups of these economies, again, we want to look at the United States, and you can see how China is bigger than the United States. Coal is extremely important, and you see the size of Europe compared to the US and China. And the next slide basically switches that and shows it in terms of percentages. Now, what this says, this is the United States in 2004, this is the United States in 2010. This is China, 2004, 2010, and Europe. Now, I've put a similar chart like this, and I've used them in presentations, but it's been very, very useful because it almost tells you what the politics of the next 20 years is going to be. I can tell you most of the political issues of the next 20 years will be about energy. That's my view. But it's really quite fascinating. If you look at the United States, you can see that about 38% of its energy comes from liquid fuels. Now that's fine when you're producing lots of oil, but if you're importing it, it becomes a bit of a problem. And as I mentioned before, we've got about 250,000 barrels a day from unconventional oil out of the Bakken, and I think it can get up to 1 million or so, but I can't see it being dramatically more than that. But the US is going to continue to be a big importer of oil. Its gas gas is taking a bigger and bigger share, and I think that's probably right, given the amount of gas that they've got. And it's quite interesting to see that gas is growing at the expense of coal. Now, this little bit up here is the nuclear, hydro, and again the renewables are pretty modest. Nuclear, I still think has got a place, and I think China is going to set the scene on that as we go forward. So politics in the United States, I think, will focus around imported liquid fuels and the better use of their gas. In China, we've got something a bit different. We've got a carbon tax. We've got a carbon tax to offset all the carbon dioxide, that terrible poison that's going into the world. But and we don't like coal here, but that's coal in China. You know, it's over 70% of their consumption, and if you have a look, it's actually grown over these last 6 years. That surprised me. I thought we were going to get gas moving up a lot more at the expense of coal, but it's still huge. There's about 2.5 billion tonnes of coal burned every year in China, so it makes Australia's position look pretty silly and pretty flimsy. The other thing which is of great interest is that nuclear energy in China is a very, very small proportion. In fact, it's smaller than it was in 2004, but there are so many new power stations coming on. I think it's 45 is a number I have in my mind, over the next 15 years. So that will become a lot more important for China as it goes forward, and gas will become a lot more important as we go forward. LNG will be important. Now, I'd like to think that as far as Australia is concerned, as being an LNG producer and exporter, it will have an infinite market in China. We won't have to worry about any oversupply because China will continue to take this. If you see the proportion in the United States, the proportion in Europe, and compare it with the proportion in China, this has got to come up to 18 to 20% over the next 20 years, whether that's through domestic production, and the Sichuan Basin's got some very large gas fields which are being developed at the moment. There'll be gas pipelines coming in from Iran and other places, but we're just going to find that gas will become more and more important. But I still think that LNG on the eastern seaboard of China will be very important. When we move across to Europe, we come back to the politics again. Gas is important, but Mr. Putin's back in charge, and I think if I was in the energy business in Europe, I'd be very, very concerned about supply of this gas. And people, if you've been looking at the prices that people are paying for gas in Europe, they're much, much higher than is paid in the United States, and they're not a lot different to what China's paying and Korea, South Korea and Japan is paying for their LNG. That really surprised me. And nuclear is coming down. Looking at the oil price, the West Texas again is not a very good indicator of prices, you really should be looking at Brent because of the slight short-term oversupply of oil in the United States relative to Cushing. But we're probably a bit oversold here. I don't know where this is going, up or down, but it should be going higher for supply reasons, but this world is a bit volatile at the moment, so I can't really tell you where it's going to go in the short term. What is more interesting is the energy index in the United States. It's better to look at these indices rather than look at what we've got in Australia, because the Australian market is nowhere near as clear and transparent as what we've got in the United States, particularly when so many of our stocks are on such low PEs. So what this is suggesting to me is that we're in a short-term pullback. We're in a longer-term uptrend, and this hopefully will be resolved to the upside in the second half of the year. I mentioned to people at my table earlier on that in presentations that I gave earlier in the year, people were amazed to see that half the Dow 30 stocks, 15 of the Dow 30 stocks made all-time highs in the first quarter of 2012. The Russell 2000 index, which is a small cap index in the United States, made an all-time high in the second half of 2011. It hasn't made new highs this year, but so many other stocks in the US have made all-time highs. And Exxon Mobil, it made an all-time high in 2012, one of the Dow 30 stocks. Now, if you're a betting player, you'd say that that's going to go a lot higher. Now, that's not what we're feeling here in Australia. We've got a huge amount of cash on the sidelines, but we've got stocks that really should be a lot higher. I think this is quite fascinating to see this. Now, in terms of what the markets are doing, we've got huge levels of cash around the world because of global pessimism. Everyone's really bearish. You can see the flight into the bonds. Bond prices in the UK and Germany and the US are very, very low. They're at record levels, absurd levels, I think, by all standards. But you know, we've just got so much cash on the sidelines. In the S&P 500, there's over $1,800 billion of cash, and you saw that Apple, I think, had about $120 billion cash. Corporate America, including the S&P, is over $3 billion. Our GDP is about $70 billion. All Ords are about $1,100 billion. Our super funds are around about $1,350, $1,380, and bank deposits are $1,380. So we've got a lot of cash, just like these guys got a lot of cash. And I've worked out that from the APRA numbers and various other commentaries that we've probably got between $350 and $400 billion of cash on the sidelines. So that's going to be the thing that will drive our market. This is bank deposits, Reserve Bank data. The latest numbers are $1,382 billion. Notably, it was down $1 billion in April, below the numbers in March. But you can see that the value of here the ASX 300 is well below cash. Cash is Australia's second biggest asset class after property. So I think that when this money decides to turn and come back into the market, it should be a pretty strong move. Now, I'm going to close this thing by saying, hey, look, I think we've still got our energy boom underway. It's just not been reflected in stock prices. No one's feeling wealthy about the boom. The silly old people in Canberra think that by taxing a couple of companies that and to share the benefits through an MRT, that everyone's going to share in the boom. But in reality, it's all those hundreds of stocks that are trading at greatly discounted prices that they're the way that people will share in the boom. But this is the A dollar. Now, I usually in these presentations put out the export revenues coming from the resource sector. They were $54 billion in 2004. They'll be about $210 billion this year. They should get to about $300 billion in financial 15. So with that coming through on our export revenue side, it's pretty hard for the A dollar to be weak. Now, this is a chart going back to 1913, so it's nearly 100 years old, or a history of 100 years. But look at this fascinating long-term chart which has been broken, this downtrend. This is a log chart. So the A dollar, and as Clifford Bennett would say, it's now trading at the lower end of the next range, not at the upper end of the previous range. We're in a new paradigm here. So I still think that this is our best indicator of where the market is going and where things are going, that the A dollar has stayed so strong and is going to go higher. So bringing it all together, there is an energy boom underway. We've got great stories that we've heard so far, and Q Petroleum, which I'm a shareholder of, which I also like. I think it's a great story coming forward, and I think people will share in this boom, this next stage, when it decides to make the turn, and I hope it's soon.